One of the things I think that is that's very obvious and was referred to in Marsh's remarks is that we're in a period where the codependence and the interdependence of the European economy and the financial system is ever more evident. And I hope that one of the reasons we're not talking about 2020 is because the programme of reform that we're embarked upon today in terms of CRD4 and Basel III, etc., goes on till just about 2020. And it would be kind of nice to think that by that time we will have got through that period of reform. And it's really around that I want to put most of my remarks today, because the challenges we're facing are immense and the solutions are neither obvious nor without risk. And as I keep reminding Mark, but he's gone now, the decisions that are taken by this generation of economic, political and financial leaders will have consequences for many years, if not generations to come, and we will all be judged with hindsight. All of us understand the imperative politically, socially and economically to understand the cause of crisis, learn the lessons, build the barriers to prevent or mitigate the impact of recurrence, reinforce infrastructure to withstand aftershocks and restore confidence so the future can be faced with a higher degree of predictability. And the challenge currently is to restore confidence. It's worth observing that there's no model, no recipe that is designed to recover or improve confidence, with that being essential to economic recovery. In light of this backdrop, the importance of the world's policymakers, and today very much so the European policymakers, coming together and evidencing their commitment to take the necessary, decisive and coordinated action to address the sovereign debt challenges, to bolster economic growth and to promote balanced and supportive financial regulation as part of restoring that confidence is clear. And there are some recent positives. The publication of the EU's crisis resolution framework, the recapitalisation over the weekend, or the proposals for the recapitalisation of troubled Spanish banks were all very positive. And as we look to the future, recent thoughts around a banking union and a common bank deposit insurance scheme are, I believe, all positive initiatives which are certainly worthy of further consideration. But as we rebuild the system, we need to be wary of two traps. First, we should be wary of using the phrase never again, because if we learn anything from history, it's that we are destined to repeat mistakes whenever we believe we've solved them definitively. And secondly, we have to avoid being over-prescriptive, as we cannot conceivably foresee every possible scenario. Now, the traps are seductive because human desire, being what it is, wants there to be some kind of order to show that fate's not capricious, that we get what we deserve, and it's a core objective of political and economic systems to promote a comforting perception of predictability. We don't want to acknowledge unpredictability, particularly around economic outcomes, and we want to believe that if there is an unwelcome outcome, it's the cause of a failing that needs to be either compensated or cause revisions to be made to the system. So we seek out definitive solutions to identified problems, but just because we demand a solution doesn't mean there is one. And I guess many people would say that would be a characteristic of the Eurozone today, if only it was possible to identify that toggle switch that can go between austerity and growth. And that leads me to there are many conflicts that I think are worthy of consideration around the European growth agenda and indeed our own industry's contribution to that if we're going to restore growth. We want stability as well as growth. We want economic growth, but we want austerity. We want banks to lend more, but we also want them to grow capital, both in absolute terms and in ratio terms. We want the banking system to have access to private capital, but at the same time we debate what the shape and capitalisation of the industry will be and whether it should pay dividends. We want to see more competition in financial services, but we don't want to see higher returns that would attract capital to the industry. We want to see fewer interdependencies, but we don't want to lose the benefits of scale. We want to incent the banking system to lend ever more to governments for capital and for liquidity purposes, but then we agonise about what happens if governments can't pay it back. We want the system to respect market signals, but we don't like what rating agencies say. We want greater transparency, but then we fret about how immediately markets react to events which policymakers are not yet able to respond to at a policy level. And finally, while we've made great strides in defining what we don't want the system to do, we've made a great deal of less progress in determining what we actually want the system to do when we're finished. And we continue to pose important questions which underpin many of the challenges in getting the financial system back to business as usual. For example, are there gaps in coverage, the so-called shadow banking problem? is the aggregate of all the measures both complete, that are complete and in train, duplicative or reinforcing? And who's responsible for ensuring that? Is there coherence between banking, insurance, pension fund and asset management regulation? Again, whose responsibility is it to check that? Just look at where in the financial system, this, the infrastructure lending that many people see as part of the renewed growth, where can it be held? Not in banks, not in insurance companies. And who knows what will happen with pension funds? Is there market capacity for the capital raising and funding assumptions that are being made? Does the understandable focus of national fiscal authorities towards limiting their contingent risk to domestic deposit bases risk unwinding many of the benefits of globalization? If fiscal authorities don't want the contingent risk of the banking system, who does? And at what price? If the consequence is to unwind globalization and establish a home market bias, does this impact the availability and cost of financial services to multinationals? Does this change the competitive landscape between those companies domiciled in the UK or Europe versus the US versus Asia? Does this matter? Does the public policy concern over systemically important institutions create a greater probability of stability because they're going to have more capital and more supervision, or does it further concentrate activity into these larger identified institutions? Current experience suggests the latter. Does the prospective bail-in of creditors change positively the probability of future bank failure because of greater market-led discipline, or does it simply reallocate systemic losses away from the future incomes of society through taxation towards society's current and future savings via insurance and pension funds? And if we've simply reallocated losses to a different pocket, have we deceived ourselves we've actually achieved very much? And finally, is there too much focus on the products, the platforms, the infrastructure, the capital and the liquidity of the system because we can define and measure them rather than address the more difficult issue of behaviour? So maybe in closing, let me turn briefly and offer some thoughts and make on financial regulation where we are and make 3 points. Firstly, the current uncertainty over the Eurozone is leading to risk management and regulatory actions today that are leading to home bias and concerted reductions in cross-border funding. To a large extent, the banking systems are becoming much more national, much less global. The result is rising fragmentation, balkanization of the global financial system. Is this what's intended? Secondly, in a world of reduced returns and heightened uncertainty, with most banks in Europe trading well below book value, equity capital raising for all but a few is infeasible. So this is prompting substantial deleveraging, which is continuing across the banking system, completely inconsistent with a restoration of growth. And thirdly, one of the most important lessons of the financial crisis, that banks must be able to take risk, must be able to fail, must be able to be resolved upon failure via an orderly, internationally coordinated process without creating destabilizing systemic shocks or requiring public intervention. Despite delivering this remains a key challenge, which I think is underway, but a key challenge for both our industry and policymakers. But to end on a more positive note, we ought not to forget that in this time of uncertainty, the financial system has a key role to play in providing finance and risk management services and in building on changes in global trade and investment flows, for which today one of the most obvious opportunities is the growing internationalisation of the RMB, in which London plays a key and growing role. So in closing, looking at both the opportunities and challenges, this prompts the reflection that this is perhaps an opportune moment to reflect on whether there should be a pause in adding further to the aggregate of regulatory reform which is already in place and in train. And maybe it's even timely to review the procyclicality of many of the current requirements and determine if this remains appropriate in the current environment. Monetary policy has delivered an incredibly favourable cost structure for investment which ought to be stimulating activity. The question for our industry and its policymakers is, how do we restore the confidence necessary to reduce the enormous premium demanded today between the risk-free rate and the return demanded by equity markets? If we can do that, the firepower available to restore growth is, I believe, immense. Thank you very much.